Funding your business and building strong business credit. Introduction. Securing adequate funding and establishing strong business credit are important elements for the success and growth of any business. In this video, I will explore different ways of funding a business and how to build good business credit. Funding options for businesses. There are several ways to fund your business. The method you use will depend on things like the stage you are in the business lifecycle, how well you are doing, and general economic conditions. A. Self-funding. Most businesses start with some kind of self-funding before they reach a point where they can attract external funding. Starting and growing a business with personal funds is often referred to as bootstrapping. Self-funding sources include personal savings and assets. This is usually the first source of funding for any business. Friends and family funding. Friends and family will often chip in when a business is in its infancy, as most startup owners do not have enough personal funds to start a business. Pros and cons of self-funding. Pros. No debt. Self-funding means the business has no debt and therefore no repayment obligations. Complete control. The owner of a self-funded business has complete control of the business. There are no investors to share control with. Cons. Limited funds. Limited funds might impede the owner's ability to grow the business, as they might not have adequate funds to implement growth initiatives. Personal financial risk. Personal financial risk is higher as the owner's money is at stake. Risk of damaging personal relationships when you borrow from friends and family. B. Debt financing. Another way to fund a business is by borrowing. There are several options for borrowing to fund a business. Bank loans. A. Traditional term loans. A term loan is when the bank or other creditor lends a fixed amount of money that is repaid over a set period with regular payments. Term loans can have fixed or variable interest rates and are used for specific business needs like expansion or equipment purchases. B. Business lines of credit. A business line of credit is a flexible loan from a financial institution that provides a set amount of capital for a business to use as needed. Interest is only paid on the amount borrowed, and funds can be used for various business expenses. As the amount that is borrowed is repaid, it becomes available again for borrowing. A line of credit operates like a credit card, but has a much lower interest rate. C. SBA loans. An SBA loan is a small business loan partially guaranteed by the U.S. Small Business Administration. It is designed to help entrepreneurs access funding with favorable terms, lower interest rates, and longer repayment periods. Online lenders and alternative financing. There's a proliferation of online lenders now who compete against traditional lenders like banks. Business owners can tap these online lenders as an additional source of finance. It's usually easier to qualify for loans from online lenders, but they tend to have higher interest than, say, a bank. Online loans include A. Online term loans. B. Invoice financing. Invoice financing is a type of funding where businesses use their outstanding invoices to secure cash advances. Businesses pledge their invoices to the lenders as collateral for borrowed funds. This allows them to improve cash flow by receiving a percentage of the invoice value up front, with the balance paid when the customer settles the invoice. C. Merchant cash advances. Merchant cash advance is similar to invoice financing, except the collateral used for the loan is future credit card sales. It is typically used for short-term funding and is repaid through daily or weekly deductions from sales. Credit cards. Business owners sometimes use credit cards to fund their businesses. Credit cards can be business or personal. Business owners should only use credit cards as a last resort to fund their business, as credit card interest rates are usually very high. 1. Equipment financing. Equipment financing is a loan or lease used to purchase business equipment. The equipment itself serves as collateral, allowing businesses to acquire assets like machinery, vehicles, or technology while spreading out payments over time. Pros and cons of debt financing. Pros. Access to a larger pool of funds. The business owner retains ownership of the business. Potential tax benefits such as interest deduction. SBA loans offer favorable terms. Cons. Require strong credit and collateral. Lengthy application process. Debt obligations could be difficult to repay if the business cash flow slows down. Lender can seize collateral if the loan is not being repaid. C. Equity financing. Equity financing is when a business raises capital by selling shares of the company. Ownership stakes are offered to investors in exchange for funds, allowing businesses to raise money without incurring debt. There are several types of equity investors. Angel investors. Angel investors provide capital to startups and early-stage businesses in exchange for equity or convertible debt. Convertible debt is debt that can be converted into equity by the lender. Angel investors often offer mentorship and guidance, leveraging their experience and networks to help the business succeed. Venture capital. Venture capital is a form of financing where investors provide funding to early-stage or high-growth companies in exchange for equity. Venture capitalists often focus on startups with strong growth potential and offer strategic support and expertise to help them scale their business. Equity crowdfunding. Pros and cons of equity financing. Pros. Larger amounts of capital can be raised through equity than debt. Equity investors are usually very experienced and can provide startups with valuable strategic guidance and mentorship. Repayment is not required. Cons. The founder's percentage of the business owned will be reduced. The founder loses some control of the business. Investors may want significant returns and influence over the way the business is run. D. Alternative funding methods. There are several alternative ways to fund a business. These include reward-based crowdfunding, e.g., Kickstarter, GoFundMe. It allows businesses to raise small amounts of money from a large number of people. Pros. Allows access to a broad audience of potential investors. No repayment or equity is required. It may validate a business idea. Cons. It requires a significant marketing effort. You must pay platform fees. Funding amount is uncertain. Grants and subsidies. Grants are funds provided by government agencies, nonprofits, or corporations that do not require repayment. Grants are essentially free money. Pros. Grants do not have to be repaid. No ownership dilution. Supports specific industries or purposes. Cons. Grants are highly competitive. Eligibility criteria are strict. Application process can be time-consuming. Business incubators and accelerators. Strategic partnerships. Revenue-based financing. Pros and cons of alternative funding sources. Pros. Diverse options. Potential for non-dilutive funding. Cons. Varying levels of competition and availability. Establishing your business for funding and credit. To establish your business for funding and credit, there are several steps you have to take. A. Choose the right business structure. Incorporate your business or form an LLC. Decide on the tax structure for your business pass-through or taxable entity. It is easier to get funding for a structured business than for an informal one. B. Obtain necessary registrations. Get an employer identification number, EIN, from the IRS. This identifies your business to the IRS for tax purposes. 2. Register your business with state and local authorities. C. Open a business bank account. Use it for all business transactions. Separate personal and business finances. Maintain a healthy bank balance and avoid overdrafts. Building your business credit profile. Just as how you build up your personal credit to qualify for a mortgage or other loan, you can take steps to build up credit for your business. You can take the following steps to build credit for your business. A. Register with business credit bureaus. Obtain a DUNS number from Dunn and Bradstreet. A DUNS number is a unique, 9-digit number that identifies a business location and is assigned by Dunn and Bradstreet, D&B, a private company. It is similar to a tax ID number and is free to obtain. DUNS numbers are used to track business activity and can be used to build business credit history, similar to credit histories for individuals. Register with Experian Business. Register with Equifax Business. B. Establish initial credit. Apply for a business credit card. Set up trade credit with suppliers. Take out a small business loan or line of credit. C. Maintain good credit practices. Pay bills on time or early. Keep credit utilization low. Utilization is the percentage of credit you use compared with what you have available. For example, if you have a credit card with a credit limit of $1,000 and you use $500, your utilization is 50%. The lower this figure is, the better it is for your business credit. Monitor your business credit reports regularly. Aligning funding strategies with credit building. Business owners should align their funding strategies with building their business credit. This is achieved by taking proactive steps like the following. A. Use funding to establish credit history. Responsibly manage loans and lines of credit. Report positive payment history to credit bureaus. B. Leverage good credit for better funding options. Qualify for lower interest rates. Access higher credit limits and loan amounts. C. Balance credit utilization across funding sources. 1. Maintain low credit utilization on revolving credit like credit cards. Demonstrate ability to manage various types of credit. Preparing for funding and credit applications. A. Develop a solid business plan. B. Prepare financial projections. C. Organize financial documents such as tax returns, financial statements, bank statements. D. Build a strong personal credit profile. Pay personal debts on time. Keep personal credit utilization low. As a startup business, lenders usually look at the credit history of the owners when deciding whether to lend to the business. Since the business might not have had time to build up its own credit, lenders use the personal credit history of the owners to assess how the business might handle its own credit. Lenders in effect see owners as an extension of the business. E. Create a credit building strategy. Start with smaller, easier to obtain credit. Gradually build to larger credit lines and loans. Managing business finances for strong credit. A. Maintain accurate and up-to-date financial records. B. Implement a robust accounting system. C. Monitor cash flow closely. D. Set up automatic payments for recurring bills. Addressing credit challenges. A. Regularly review credit reports for errors. B. Dispute inaccuracies promptly. C. If facing financial difficulties, communicate with creditors proactively. Negotiate payment plans if necessary. Seek professional advice when needed. Long-term strategies for funding and credit. A. Diversify funding sources. B. Continually reassess and adjust credit building strategies. C. Build strong relationships with lenders and investors. D. Regularly review and update your business plan and financial projections. Successfully funding your business and building strong business credit are interconnected goals that require careful planning, diligent management, and patience. By understanding the various funding options available and consistently practicing good credit habits, you can create a strong financial foundation for your business. Remember that both funding needs and credit building are ongoing processes. As your business grows and evolves, regularly reassess your funding strategy and continue to monitor and improve your business credit profile. With a solid financial base and strong credit, your business will be better positioned to seize opportunities, weather challenges, and achieve long-term success. And that's a wrap for funding your business and building business credit. This is our 12th video on this channel, and we're just getting started. We will continue to delve into the world of accounting, finance, investments, and taxes, giving you useful information that you can apply in your personal, professional, and business lives. Stay with us on this journey. As always, like, share, and subscribe. Let us hear your feedback in the comments as well. See you in the next video.